Like, what's been the biggest lessons apart from what you've already shared?
Yeah. And I don't know if this can answer what you're asking, but you just triggered a thought in my head that, stay away from the extremes, right? So there's the extreme of if people really hear the kind of, earnings from work, they barely hear it. Lifestyle or expenses, they barely hear it. But earnings from investments, they really hear that. And, there's a group of investments that you can call alternative or exotic investments or private investments. And I make a lot of these type of investments. They're very, very risky.
Yeah.
And you're hoping that they get you a substantially larger return, but they can go to zero. So you can lose your entire principal.
Yeah.
And so what I would say about that whole asset class, right? If you think about like checking accounts, saving accounts, CDs, safe, treasury bills, whatever, safest stuff out there, right?
Can I ask about that though? So CDs, cash deposits, but with inflation, then that money is actually shrinking sitting there. But are you just saying you still need to have that safety net, even though it's the value of that asset is decreasing in an inflationary?
Part of what I was saying is that that's an extreme, right? So that's an extreme on one side of the extremely safe side where there is such a thing as being too safe, right?
Yeah.
But I'd way rather be on that extreme than the other one, but you can be too safe. But, these days CDs and bank accounts will pay 4+%, some of them 5+%. So you can actually do quite well in some of these things relative to their risk, which is zero if they're FDIC insured. So that's incredible. You can get 5% with FDIC insured money. That's just insane. That means it's literally cannot go away unless, the United States of America ceases to exist as we know it, right? So then you move to the next category, which is stocks and bonds. I'm not that big into bonds. Some people are. That's great. So I'm not going to talk about it because I'm not into it. But stocks is still, if you've got a time horizon that's long enough, then stocks, if you're buying an index fund or if you're buying an ETF that covers a broad index like the S&P 500, then that is also still very safe. It just obviously can fluctuate quite a bit in the short term. But if your time horizon is long enough, that's still very safe. And then on the alternative side, you can certainly push up returns higher than in either of those two, but you're taking substantially greater risk. So I would say to people, be careful about this, alternative investments category. I'm not saying don't do it. Part of how I got where I am is investing with a friend who is he's a developer. So he'll buy houses. He'll either tear them down and build something new and then sell it, or he'll just do a very, very large renovation on a property and then sell it. And what I was doing was investing those projects. It's essentially the equivalent of buying stock in the outcome of that project, right? So you're going to have a 9 to 18 month wait or something like that. It depends. It could be a lot shorter depending on what the amount of work is somebody's going to do. But that was a major contributor to where I am today for a period of some years when a friend of mine was doing that full time and there was a lot of opportunity and he needed capital and I was very happy to be involved with this and so on. So these things can be very much needle movers. You just have to be careful. And if it's not someone you've known for 10 plus years who's telling you about the opportunity, you just need to be very skeptical and look at a lot of them. And if you encounter someone who will act as even remotely any kind of mentor or strip that word out and call them whatever you want, who's been investing in this asset class for 10 plus years, then be a very good idea to throw a sidecar onto that person and try to invest where they're investing. But, start out with small dollars. Just remember that this asset class can lose, right? The savings and CDs, they can't go away again unless the U.S. government goes away. Stocks, if you buy something that's trailing the S&P 500 or tracking the S&P 500, it can't go to zero because all the worst performing companies are replaced with the best performing companies. So over time, you'll be fine there. Over here, you can lose everything you put in. So be careful as a percentage of your total, net worth or assets that you're putting into any individual deal. That's a big one, by the way. That is another thing. I don't mean to go off on several tangents here.
I'm soaking this up. So before you get to that, you're about to talk about percentage of your capital that you invest in any one deal. But what about asset allocation overall? And obviously everyone has their own formula based on age and risk appetite, but like, what's your philosophy there?
I don't. So first of all, I'll just say that I don't use a financial advisor. If I did, they would have probably already forced me to have a much more formulaic with, numbers behind it that were very exact. Yeah. And so instead, mine is a little bit more of kind of a loose construction of what I feel makes sense for me. Okay. And there's a lot about like a stock and bond portfolio and what percentage it should be based on your age. I am not very inclined to go heavy into bonds anytime soon. Yeah. So for me, I'm much more interested in riskier assets, which would be, in the stock market, although I don't buy a lot of individual stocks. I'm buying, ETFs or index funds that track.
Like a Vanguard sort of index fund type thing.
Exactly. Yep. Whether it's the Vanguard or SPY that tracks the S&P 500 and the ones that track, the Russell 2000, the NASDAQ, an international one. And then there are bond funds out there. Now, when I hit a certain age, and I can't say this with confidence, but let's say around 65, I'm probably going to suddenly become a lot more interested in bonds than I am today. But so I am comfortable with, now I keep a somewhat substantial amount, both in general and as a percentage of my total assets in those really, really safe things, because I'm always going to be of the mindset of waiting for some time when assets go on sale.
Well, you just described your inclination is skeptical, pessimistic when it comes to finance. So that makes sense.
And therefore, I want to be ready when assets go on sale to purchase a bunch of them on sale.
Okay,
right?
Brilliant. Yeah.
And I did that in 2002 and I did that in 2009. I still did it skeptically at lower levels than I wish. I had kind of amped up the amount of that I did, but I always felt like you never really know where the bottom is. So I'm going to be, cautious as I do this. But so I would say though, so I answered your question to say I don't have a real answer.
Okay.
But my number one thing is no matter how great you think something is, I've heard people say things like, this is working out so well that I'm going to put all of my assets into this or, 80 or 90% of my funds into this or my entire 401k. That is terrifying when I hear that. And usually when people say that, they're not asking my advice. They're just informing me. And it's a terrifying thing for me to hear.
Yeah, no, absolutely.
Because that's, nobody knew that Bernie Madoff was Bernie Madoff until, the tide went out and he was naked, right? Yeah. So you just don't know. So the easiest way to protect against fraud or gross mismanagement is to be diversified.